Good morning from our global headquarters in New York. I'm Manish Kranny alongside Danny Berger. You're welcome to Bloomberg Brief. Let's start that agenda.
A German bond route goes global. Yields in Japan, Australia, and the U.S. all rise as EU leaders gather for an emergency defense summit. In autos reprieve, President Trump exempts car makers from tariffs on Canada and Mexico for 1 month. All of that ahead of an ECB decision expected to lower rates for the 6th time since June. Good morning, Manis.
Danny, a very good morning. Let's start with the global bond market, right? You are just seeing significant moves in Japan and Germany, and we are being dragged in the wake of that in the United States. The bond market is up at one juncture 44 basis points in the space of 2 days. The worst drop since the 1990s. The JGBs trading at 1.5% for the first time since 2009. And as I say, the growth scare that we saw our yields drop yesterday has been evaporated by this global bond market, right? Vigilantism or bonfire, take your superlative. Roll it down to the stock markets. I mean, we are headline whiplash, really, when it comes to these markets. A lot of the tech sector under pressure this morning. Again, just going back to what Bob Michael said, the risk of tariffs, even though we have carve-outs, are economy killers, and that is probably the overriding risk in this market.
How do you price in tariff risk when it changes day by day? Manis, you're seeing the same thing on an individual stock level basis. Let's just get into some of the things moving pre-market, because Ford is one of these. It rallied more than 5% yesterday. It's now down 1% in the pre-market. That and other car makers, again, they had a large rally with that Trump delay, 1 month delay to auto tariffs.
Chinese retail giant JD.com posted a beat in the fourth quarter. The company benefited significantly from the Chinese government stimulus efforts to spur consumption.
Elsewhere, this also weighing on the tech sector this morning. Marvel Technologies plunging nearly 16% in the pre-market. Revenue fell short of estimates, whereas investors had been hoping for an AI-driven boom in results.
And in just a few moments, Lucy Baldwin of Citigroup, and later this hour, Ludovic Subran of Allianz joins Danny and I. I mean, that is a brutal repricing in those equity markets. And there's a lovely line from George Conclaves over at MUFG. For the first time, we're really questioning the golden goose here in the USA, whether it's fiscal and tariff angst globally.
Well, we're being hit by tariffs, headlines about layoffs and the DOGE efforts. And all of that is happening notably when Europe has switched on the switch to stimulus. It is this repricing because it's an idea of not MAGA anymore, but now you're starting to hear people talk about mega, make Europe great again. And look, Bank of America also lays it out this morning, saying that signs of uncertainty, shock hitting the U.S. consumer, and risk assets should be taken seriously.
And also the sort of the framing of the tariffs yesterday by the Commerce Secretary, Howard Lutnick, on Bloomberg, which was this is more about fentanyl rather than it is about trade. So it's trying to sort of recraft the narrative. But it's live. Tariffs are taking shape on a daily basis. And shares of the automakers, well, they're on the move this morning as President Trump grants an exemption for the automakers from the newly imposed levies on Canada and Mexico. Now, the reprieve will last 1 month. How will they perform in that month? Brendan Murray, who tracks the trade story for Bloomberg, is with us. This was a very public, I think the phrase that you use, Brendan, is this was very publicly played out. But you question the proportion of exemption.
Yeah, so we did see this carve out for the auto industry, but that's still, that 25% tariff still applies to about $600 billion worth of trade between across North America. So, and the auto exemption or exclusion that they're getting, accounts for about 250 billion, according to some of the economists who we're tracking. So there's still we're in day 3 of what is still a very disruptive trade war between the 3 economies of North America. In the meantime, we have China trying to position itself to withstand the added 10% tariff that the Trump administration put on Chinese imports, and trying to stabilize its economy and make sure it can absorb the shock from those tariffs. So yes, there was a reprieve for the auto companies yesterday, but we're still in for a number of disruptive days ahead. Remember, next week we get steel and aluminum tariffs coming into force. So that'll bring in countries in Europe and more countries in Asia. So the trade war is just kind of creeping ever outward to encompass more economies. And we heard Howard Lutnick say, April 2nd is when the reciprocal tariffs kick in. So that's an even a broader round of disruption that we're going to see.
And maybe there's some degree for why we're not seeing a follow through on car makers, which is, okay, 1 month reprieve. And then what? And Brendan, the kind of gamble that President Trump has made, and he said this publicly, is that the U.S. can withstand these tariffs and other countries can't. But J.P. Morgan putting out a note saying that the tariff tango for the Mexican president, that she's dancing with him, has been a boon for her popularity. Her approval ratings hitting an astounding 85%. Politically, we see Trudeau also standing up for Trump. Is there a degree which these leaders, politically, the gamble to stand up to Trump is actually working for them? It means that they won't back down.
Yeah, it seems to be. We're seeing different tones being taken by the leadership in Canada and Mexico. Trudeau is very much standing up and sounding tough and saying we will fight you in this trade war. Sheinbaum in Mexico is playing it more a bit more measured approach, but she has also said that she's going to announce reciprocal tariffs, retaliation on Sunday. So we could see food items, everyday grocery store products that Americans buy. We could see, those hit in this trade war as well.
Brendan, thank you so much. That is Bloomberg's Brendan Murray. Over in Europe, EU leaders are meeting in Brussels to discuss how to unlock billions of euros to boost European and Ukrainian security. The summit also comes after President Emmanuel Macron addressed France last night, saying that he'll enter into talks to use the country's nuclear capabilities to defend European allies. Let's go straight to Brussels, where Bloomberg's Oliver Crook joins us now. Oliver, it is a complete rethink in how Europe will be spending. You see the ramifications in this bond market. How is that conversation evolving there?
Yeah, Danny, I mean, this is really a truly seismic shift. They've been talking about these European leaders, a wake-up call since November. This is the week that Europe got out of bed. And that happened at the EU level, where you have hundreds of billions of dollars that are going to be deployed in various different ways, including sort of direct loans, 150 billion euros. That is what's going to be discussed today. But also easing of fiscal rules across the European Union among member states, so that EU rules, basically, they can debt finance defense unlimitedly without the constraints of the European Union. And I think the most staggering part of all of this, and really where the real sea change is that sort of loosening of fiscal rules, encouraging European nations to take on more debt, has been lobbied by the incoming Chancellor of Germany, the CDU head, Friedrich Merz. That is the true sea change. And though Friedrich Merz will not be in these meetings because he is not yet Chancellor of Germany, he is really the person who has shifted things significantly here in Germany. We think about this on the day of the ECB, where we generally look at the ECB to move the markets. The ECB could not move the German 10-year yield by 10, 20, 30, 40 basis points, which is what we've seen over the last few days. So there's a shift from this sort of focus on monetary policy and the sort of to the politics, and really a sea change, really truly here in Europe for the very first time, really being precipitated by Donald Trump and his actions really in the last week.
Yeah, profound fiscal response. That's what's expected. Oliver, thank you very much. Oliver Crook, tracking the EU gathering. Let's stay with Europe. The ECB rate decision, as Oliver just said, is coming in 3 hours' time. And we're expecting another cut. Lizzie Burden joins us from Frankfurt. Lizzie, the assumption is 25 basis points. The only conversation is the press conference and what Lagarde has got to say about the fiscal response and whether we are at or near neutral, isn't it?
Exactly, Manus. Do they drop the word restrictive in terms of describing their policy? That the absolute signal of whether there's going to be a cut in April or an end or pause to cuts to come. That fiscal conversation around Merz's whatever it takes pledge, of course, going to dominate this press conference. Is it going to boost growth, this pledge? That is what the markets seem to think is going to happen, hence why you've had the Bund moves, the euro-dollar parity bets being thrown out of the window, the traders paring their bets on ECB cuts this year because they see this adding more to growth than it does to inflation. Goldman saying that it's going to add 2% to German growth next year rather than 0.8%. But of course we need to see what happens where Ollie is in Brussels today. Lagarde likely to be asked, what's the ECB's role in all this? If it isn't making it cheaper to spend all this money, what about if you have these heftier budget deficits threatening debt sustainability, and then maybe you need to bring back the large-scale bond purchases through the transmission protection instrument?
Lizzie, it's not even just the unknowingness of what fiscal policy looks like. It is both the tariff threat from the U.S. and the war in Ukraine that could vastly change the outcome for the European economy. How much of an indicator, how much of a projection can the ECB really give at this point?
Well, you hit the nail on the head, Danny, because the ECB doesn't make policy or projections based on policy that is, well, just a threat at the moment. And that is all the tariffs are at this point. 25% tariffs on autos and all other things. But it is only a threat at this point. We don't know what the EU's retaliation is going to be to those tariffs. Interestingly, if you look at our survey, most analysts don't see tariffs moving the needle much when it comes to GDP or inflation. But we need to think about whether this is in the long term going to outweigh the fiscal threat. I'm sure it's what's going to come up in the press conference with Christine Lagarde. Morgan Stanley's Jens Eisenschmidt says that it's more going to be to do with the energy cost uplift that raises the inflation outlook. But what you could see is a change of language on trade policy, and Donald Trump very much the elephant in the room of this ECB policy decision.
Lizzie, thank you so much. That's Lizzie Burden in Frankfurt. We'll also catch up with you later in the hour as we count down to the ECB decision. Let's first get some other top stories that are trending on the terminal this morning. Bloomberg sources say that Klarna Bank is seeking to raise at least $1 billion in a U.S. IPO as soon as next week. They aim to price the IPO in early April, targeting a more than $15 billion valuation. Deliberations are ongoing. Details of the listing plan, including timing, could still change.
Michael Grimes, a former Morgan Stanley banker, is set to lead a planned sovereign wealth fund to give the U.S. a stake in projects considered critical to national security. The fund would be part of a larger public-private collaborative effort to open up large-scale institutional investment options. Grimes couldn't immediately be reached for comment.
Alibaba has unveiled its latest AI tools. They marked a big leap over the previous version. It used just a fraction of the data that DeepSeek's R1 employs. Alibaba has gained some $135 billion of market value this year. Alibaba has also pledged to invest more than 380 billion yuan on AI infrastructure.
Coming up, we'll bring you the market reads through the tariff exemption and Europe's fiscal plans. All that with Citi's Lucy Baldwin. Join us in just a moment.
It's Bloomberg Brief. I'm Danny Berger alongside Manus Cranny in New York. Manus, it feels like a new world order, one in which German yields, once frozen, have become unglued. Yesterday, clocking the biggest jump in yields since reunification in the 1990s. Let's take a look at where we stand now, because it is a sell-off that has gone global. Also, speaking of a new world order, it is bond yields in Japan moving higher by 9 basis points. Yes, the sell-off goes the U.S., but it is capped with those concerns over growth. Pleased to say that joining us now is Lucy Baldwin, Global Head of Research at Citi. Lucy, it's a moment where we're inundated with tariff and layoff headlines in the U.S., and you have concerns about growth at the very same time that Europe has flipped the switch onto stimulus. Is this the right way to think about it? Are we witnessing a shift away from American exceptionalism and to making Europe great again?
Good morning. Thanks for having me. Yeah, look, it's certainly a big question whether this is actually a fairly fundamental regime shift that we're starting to see. And certainly our sense is it's pretty significant. You know, the level of stimulus that now Europe is committing to ultimately bolster GDP growth over the next 5 years in Europe, and that should unlock some significant earnings growth and upside to earnings growth across the corporate space. And then on the flip side, to your point, as Europe embarks on that fiscal stimulus, as you say, pretty unprecedented by its history, you've got now the United States really starting to grapple with the levels of uncertainty that have been triggered by the new administration over the course of the last few weeks with the approach to relationships around the globe. So essentially, you're seeing that consumer weakness start to come through. And I think that is our biggest concern. We've got a big consumer conference next week, actually, in Miami, and we're going to be listening very carefully to see what's happening to the US consumer, because all of the soft data is really pointing to this quite remarkable slowdown in US growth on the back of much less confidence, both from the corporates but also from the consumers, as they adjust to the tariff whiplash that we're starting to see across markets. So I think it is quite a big shift in terms of regime, and actually it's something we've been talking about since the back end of last year. You know, this is no longer the case of just wanting to be exposed to a few small parts of the US market in number terms, admittedly huge in value terms, but that need to have that cyclical diversifier outside of the US market has never been more apparent.
There's a lot to unpack there, Lucy. Let's just break it down. You've got the consumer side and you've got the flows into Europe. We've had fast money flows into Europe since the start of the year, but there's a fundamental shift in the price of the euro and in the price of European assets. If that's fast money, is there a structural asset allocation adjustment to follow through on the back of the fiscal change?
Yes, I would expect to see that coming through, because I think this is a fundamental shift in the prospects for growth for Europe. This is, as we know with Europe, sometimes it takes, a real crisis to catalyse action. But there's no doubt that the German reaction here to going out and spending more, not just on pure defence, but on broader infrastructure, including digital infrastructure, could be a real game changer for growth and productivity across Europe. So we feel pretty excited about those prospects to upside for growth. And that, of course, is going to drive earnings per share growth across, hopefully, the European market in time, across that industrials complex, but also further downstream. It should generate jobs, etc. And that optimism and enthusiasm for Europe is just what we need to see to attract those flows sustainably back in. And obviously structural changes in asset allocation, which to your point have become very skewed to the US market from a global perspective over the course of really the last decade. This takes us back potentially to a regime for Europe that looks much more like pre-GFC, right? The non-zero rates, the slightly higher levels of inflation. But ultimately, during that pre-GFC era, Europe was not a perpetual underperformer versus the US, as of course it has been since.
Well, the consequences of that flow, Lucy, you're starting to see some digital ink being spilled about this idea that it will challenge the U.S. dollar's status as both a haven currency and just its dominance. Larry Summers was speaking about this yesterday, saying that the volatility was to blame. George Saravelos writing yesterday, we do not write this lightly, but the speed and scale of global shifts is so rapid that the idea that the dollar will lose its safe haven status needs to be acknowledged as a possibility, considering the underperformance of U.S. risk, the declining correlation between U.S. and dollar and risk assets. Lucy, is that a threat, the idea that the dollar is the ultimate haven?
Well, of course, at the margin, a lot of these policies, if we see tariffs remaining, right, there's obviously a massive amount of uncertainty around what comes in, how long it stays in. We've obviously seen the exemption in the auto space, right? So if we actually see tariffs coming in and remaining, there's that retaliation that happens is a huge series of negative demand and supply shocks, right? All of which are likely to weaken global growth. And I think to your point, and the point that Larry will have made, is the challenge for the dollar is if the US continues to negotiate around the globe with big trading partners, whether that's Europe, whether that's China, in a way that starts to cause other partners to form new alliances away from the United States. We've obviously seen what's happened with Mexico and with Canada. Again, seen as the biggest, strongest allies, incredibly close in proximity, great ties within certain sectors. There is that risk that other people form new alliances in order to try and buffer themselves from the shocks that this is causing. And I do think that has a risk, obviously at the margin for the dollar. We've just actually changed our view. We'd been saying last year, dollar strength on the back of the election and post-election and the policies that were coming through or seem to be coming through. And our view right now is actually that's probably not where you want to be. And we've actually said let's be much more constructive on the euro here on the back of what we've seen in the last 24 hours. So absolute truth in what you're saying there.
Lucy, thank you so much. Lucy Baldwin there of Citi on the markets. Let's just show you where these bond markets are. That's where we started the show 21 minutes ago. As Danny said, there's a cap on the spike in our bond yields in the United States of America at 430. That's the growth drag relative to the seismic shift that you've seen in the bond market, Danny. 2 days in the German bond market, we've put on at one juncture 44 basis points. We're seeing the worst drop since the 1990s, but it is seismic changes in fiscal policy. It's time for your front page news. This is what we got on the headlines from around the world. Kick it off with the FT. They're reporting that Microsoft has withdrawn some of its commitments with the cloud computing provider CoreWeave. Now, Microsoft is by far one of the largest customers there, but it has walked away from some of the agreements over delivery issues and missed deadlines. Representatives from Microsoft and NVIDIA declined to comment to the FT.
This one breaking on the Bloomberg moments ago that Walmart has asked some Chinese suppliers for price reductions to offset the cost of tariffs. They've asked for up to 10%, but so far few have acquiesced. Already really razor-thin margins for suppliers, with Walmart trying to price cheap goods.
Yeah, we've had a bunch of CEOs warn Target and Best Buy, you're going to have price hikes pretty soon. Washington Post leads with President Trump is set to issue an executive order directing his newly confirmed education secretary to work to close the department. Now, it would take an act of Congress and 60 votes of yes in the Senate, which is unlikely given that the Republicans have 53 seats. But the more likely outcome are deep cuts to staff and programs along with grants.
Well, coming up in the show, we're going to count down to the ECB decision. A lot to grapple with for Europe. For more spending, a seismic shift. We're going to catch up with Ludovic Subran of Allianz, and that's next on your brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
A German bond rout goes global. Yields in Japan, Australia and the US all rise as the EU leaders gather for an emergency defense summit. An autos reprieve. President Trump exempts car makers from tariffs on Mexico and Canada for 1 month. And all of that ahead of the ECB decision expected to lower rates for the 6th time since June. Danny, good morning. These bond markets are on fire.
And the reprieve for the equity market did not last long either. We started out yesterday with able to put up more than 1% gains. We're falling by nearly 1% this morning. For your S&P and Russell 2000 futures, NASDAQ underperforms 1.1%, despite getting a 1-month reprieve. But it's just for autos on tariffs, which is only 25% of the imports coming for Canada and Mexico. And yes, Manus, you said it. It is a bond market that is maybe wagging the dog this morning. It is a new world order where German yields have come unglued. We're higher by about 6 basis points this morning. The 10-year bond jumped nearly 30 basis points yesterday, was the biggest since the 1990s German reunification. Your 10-year yield in Japan crossing 1.5% for the first time since 2009. Your 10-year yield only up 2 basis points, so it's participating in the sell-off, but maybe not to the extent. And man, it's just to underscore the volatility that we've seen. This is a wonderful statistic. European equities, Monday, see their best day since 2022. On Tuesday, European equities see their worst day since 2022. Yesterday, it was again their best day since 2022. Try to wrap your head around that.
Well, the one thing the bond market is telling us, even though there's existential angst in Germany and in Japan in terms of the scale of those moves, that cap, and you flagged this at 5 a.m., the cap in the US bond market is specifically on the growth drag. The risk here, if you look at the ADP numbers, ahead of the jobs numbers, that is the drag. That is the risk on the stag side of the stagflation narrative here in the United States of America. And if there's a print tomorrow in that jobs market that indemnifies that stag side, it's a very different bond market. And that spread between U.S. Treasuries and the rest of the bond markets in the world will shift.
Listen, we talked to Mark McCormick at TD Bank yesterday, and he basically said the market has this order wrong, that actually the concern now should not be growth. It should not be an inflation. It should be inflation. Yes. You see that in the Beige Book. They talked about how various districts said that they were preemptively rising prices. You also see Walmart saying, Chinese suppliers, you need to cut prices. There's this grappling of higher prices, and it's being mentioned over and over again for these corporations.
It is indeed, and all of that on ECB day as well. So you can sort of wrap it all up together?
Well, to be fair, expectations are that the central bank in Europe will be cutting rates again, but traders are now only pricing in 2 more cuts this year with the stimulus coming into Europe. Let's bring in Bloomberg's Lizzie Burden, who's on location in Frankfurt. So, Lizzie, a cut today, and then what?
Well, even before all of the tariff and defence and infrastructure news, Danny, it was anyone's guess what would happen after April. Today seems pretty clear we're going to get a rate cut. But beyond that, analysts are divided. The Governing Council is divided. You've got some analysts saying that today is it. And then you've got others saying that they're going to cut all the way to 1% by the start of 2026. If you look at the Governing Council, you've got some who are concerned about sticky services inflation, others who are still concerned about sluggish growth. Maybe the German pledges do somewhat to change that. But if you come down to it, the data, this week we've actually had quite optimistic signs. You've had services inflation falling below 3.9% for the first time since April 2024. Wage growth easing in the fourth quarter. Maybe that gives the confidence that policymakers need that they can get back to 2% in the coming months. I said it before, I'll say it again. The tell for markets today is whether they drop the description of policy as restrictive, because if they do, that could signal an end or a pause to cuts. But if they don't, that'll be a signal maybe that we're going to get another cut in April.
Well, Lizzie, Germany has laid the roadmap for Europe to have a fiscal response that sort of comes up to their own. The size of the German fiscal boost is the biggest since World War II. Europe has an opportunity to do the same. The question for markets is the boost to the growth side versus the threat from the tariff side coming down the pike from the US.
Well, of course, the EU stance on tariffs, the ECB stance on tariffs is, at the moment, they're just a threat. 25% on autos and all other things. And we don't know how the EU is going to retaliate at this point. It doesn't look, actually, at this point, that it's going to do much to change the ECB's projections when it comes to inflation and growth. But when you consider that mammoth pledge on doing whatever it takes when it comes to defence, and there's also infrastructure to factor in here as well, as you say, historic in terms of the market reaction, the Bund reaction, the euro reaction, and traders paring their bets on ECB cuts because they see this adding to growth. Goldman saying it could add 2% to German GDP, up from 0.8%. But the caveat, as always, is it's got to be approved and it's got to be implemented quickly. Now, we're going to wait for the news out of Brussels on the Europe-wide level, but Christine Lagarde will not be able to escape this question. How is she going to support this effort? And Indeed. Is she going to have to return to the transmission protection instrument because of the impact on spreads?
Lizzie, thank you. We'll catch up with you later in the day for coverage at the ECB. I want to just show you, Danny's talked about the Bund price, just for your viewing here, up 44 basis points in the space of 2 days. This is a seismic shift, according to a number of houses. This is of debt, potential debt issuance and fiscal stimulus of epic proportions. How should we view it? Ludovic Subran, Chief Economist, Head of Economic Research over at Allianz, joins Danny and I now. If we look at this potential fiscal response, it's a paradigm shift to sort of put all the superlatives together. But it's something different to the existential threat that was the debt crisis in 2011. How do you look at it from a boost to growth relative to inflation? Ludovic, good morning.
Good morning. I think it's in the short term, it's definitely a boost to growth and not to inflation. I think when you talk about war economics, it usually builds precautionary savings and lower capex of the firms, right? So there is a demand addition. The multipliers of defense are usually high. Plus, in Germany, the stimulus announced is half defense, half infrastructure. So it should actually be quite high. So we're talking about a point or a point and a half of growth over the next few years, right? So it's quite huge for a country that is just being in recession for the past 2 years. I'm not worried about inflation now, but we should stay worried about inflation in the future because we know the problem of war economics. War economics grants a form of inflation if there is no capital destroyed. We learned that firsthand from COVID response because we were at war against a virus. We did rationing. We did strategic allocation of capital to the effort of the war. We did debt monetization. And then 2 years down the road, we got a lot of inflation because there was a supply shock that ignited everything. So we need to be very careful here. I'm not careful about inflation now. I think the rates are responding to the uncertainty. They're responding to the additional issuance. But I think it's very overpriced and very knee-jerk a reaction. So I would be long Bund anytime now. Actually, I think it's time to add duration to the portfolio for investors out there.
Well, Ludo, kind of to that point, the numbers we're talking about, just sticking with Germany specifically, 500 billion euros for infrastructure spending, a removal of any of the debt limits when it comes to defense spending, so hundreds of billions more there. Do you assume that that actually gets done? Part of the reason we're talking about this being such a seismic shift is that it's so different from the German austerity posture that we usually get.
It will happen in some form. The problem is getting it right? Because there is always disbursement bottlenecks. There are always risks of these bold move strategies because you don't want to put all your heads in the same basket. There is always the problem in Germany to keep the reform momentum. And so there is a lot of discussions now on how, now that you unleash, that you unveil this public sector component, that you keep also the other part of the societal compact, and I would say of the other reform agenda up and kicking. I think it will happen. I mean, look, Germany needs so much investment into the grid, almost 200 billion, so much investment into transport infrastructure, 200 billion, that this has to happen. It's over 10 years, it's 50 billion per year. They have disbursement options around that. For the defense, it's a lot trickier because right now, any additional spend on defense cannot go to Germany because there is not a lot of capacity apart from Rheinmetall. You saw the stocks of these companies going up. So it's going to go a lot to the UK, a lot to France, a lot to Italy. So I'm a bit worried about how Germany feels about the positive spillovers of these defense demand on other partners. Actually, Macron is very rejoicing at the moment. So we have issues here, but something is happening for sure. And even if it's crumbs in the beginning, I think it's still very positive for a country that has been stuck into a recession for the past 2 years now.
So if the sovereign bond market is repricing to the potential for fiscal stimulus, when you look at investment grade and when you look at high yield, they need to prepare for something different. They need to prepare for Trump trade war 2. And those spreads are relatively contained, Ludo, relatively contained at the moment to where they were in 2018 in Trump trade war 1. So talk us through how you look at the pricing there in high yield and IG. Unfortunately, I'm an internal bear when it comes to credit risk. I think the spreads are too tight. I think the default numbers are too low. I think rating migrations risks are under-evaluated, and there is a lot of mispricing in the credit space. I think the correction we've seen in the equity market is not reflected yet in the credit space. It has to happen. This is basic Shapiro formula. So I would be very worried about, the fact that defense creates a form of sectoral rotation, plus trade war, very affecting of the companies that are issuing on the high yield market, plus the other frictions that we are not talking about but are there, of course, on the very transition risk, and then the regulated sector risk and the substitution risk of all this actual focused investment in defense. I think we should be very careful. I think we should look again at the fundamentals. We should not also forget about private debt, which seems to be hot these days, and it's great. I just saw the retailization of the private debt products in the US becoming an issue. I think credit risk is going to be in the news for all of Q2. And this is what's happened when you have a growth scare in the US, reflation, you talked about that in the intro segment, plus a central bank in the US that won't be able to go much further down than 4%. So this is where the credit risk space will be higher. In the US, I would say the problems. In Europe, I guess the issue for me now is this war economic stuff. I'm a bit worried that we don't know how to deliver this promise. And so that could create credit risk for those companies that are hot right now, especially when you look at the additional refinancing needs that will be done in the manufacturing sector. We need to be very careful about how this refinancing happens because of the cost being slightly higher.
Ludo, you are truly one of the best. It is so wonderful to have you on. That's all we have time for. Ludovic Subran of Allianz, thanks so much for joining us. Coming up on the show, President Trump grants a 1-month tariff delay for car makers. We have the details for you next. It's your Bloomberg Brief. Danny Berger alongside Manus Cranny in New York. U.S. automakers are falling in the pre-market, giving up some of their gains yesterday after President Trump granted an exemption to car makers from the newly imposed Canada and Mexico tariffs for 1 month. Bloomberg's Brendan Murray is back with us. Brendan, do we have any more clarity on what tariffs look like to Canada and Mexico than we did 24 hours ago?
Not really. I think what the lesson that we've learned in the past 24 hours is that tariffs are not just a blunt instrument, but it can ricochet back at you. So we've seen the reprieve given to the automakers. That will help save roughly $200 billion worth of trade from those 25% tariffs. But there's another $600 billion in trade that's going to get that 25% tariffs, and then you get the retaliation from Canada and Mexico, and also the retaliation from China, and you create. There's a picture that's getting more disruptive and cloudier rather than clearer. And the Trump administration has said that it's going to press ahead with this tariff with these tariff policies. We get steel and aluminum next week. Cars are made of steel and aluminum, so that's going to affect the U.S.'s industrial base as well, and invite retaliation from Europe and some steel exporters in Asia as well. So the picture, you can see a scenario where this situation kind of snowballs and starts to affect the economy. We saw the Beige Book yesterday from the Federal Reserve had 49 mentions of tariffs in there, and they weren't complimentary. These were companies complaining that tariffs are going to force them to raise prices or do other things disruptive to their business. So I think the picture, rather than getting clearer, is getting cloudier as we see the Trump administration roll out these policies.
And that's despite the Commerce Secretary joining the surveillance team yesterday saying this is not a trade war, it's a drug war. It's a drug war between now and April the 2nd. And there's the point, Brendan. April the 2nd is the day in which we understand the magnitude, the scale, and the breadth of a regime change in tariff pricing from the United States for the world. This is a paradigm shift, and a shift higher in prices is the assumption.
Yeah, exactly. So we go from applying tariffs not just for economic reasons, but also for non-tariff barriers, things like value-added taxes and other sorts of policies that the U.S. would interpret to be a barrier to trade in that country, and that's going to be different for every country. They've talked about the U.S. banks' access to the Canadian market, so it's going to be a piecemeal type approach, country by country approach that the Trump administration says that they're going to take, and it's going to be a complicated thing to figure out the economic impact of that, and tariffs are only just the beginning if the Trump administration follows through on what they're pledging.
Well, it's adding to those growth scare that sort of building in this market. Brendan, thank you very much. Brendan Murray, the very latest on the tariff story. Corporate America bracing for the tariff impact as well. We'll hear from Macy's and their latest earnings call before the market opens. Bloomberg learned that Walmart has asked some Chinese suppliers to cut their prices by as much as 10% to offset the cost of tariffs. Deirdre Hipwell joins us for a bit of a preview on Macy's and the consumer overall here in the United States of America, the hedonism of the U.S. consumer. Good to see you this morning. Let's kick it off with Macy's. They've really shook up the structure of the company. They've closed stores. They've refreshed a number of their shops. What can we expect?
Well, I think, the department store space in the US is always such a challenging space to be in. So there's really going to be a close focus on Macy's because people are really going to want to see if the CEO, Tony Spring's strategy is working. And of course, the strategy is focused on closing down some loss-making stores, focusing on fewer stores, selling fewer and better products. And I think people are going to want to see where that is taking the company at the moment. In terms of what they're actually expecting, I think they're expecting revenue, roughly a quarterly revenue of about $7.76 billion and adjusted earnings per share of 1.54. And they have topped EPS estimates in the past, so I think we'll be looking to see if they can beat rivals such as Dillard's and Nordstrom's, which have already beat expectations when they reported.
Deirdre, if we could take a step back in this moment for the consumer, we had a fascinating beige book published yesterday. On one hand, it said that most firms expect prices to move higher with tariffs, and they plan, for some of them, preemptively rising prices. But then they said this about consumer spending, that it was lower on balance, with reports of solid demand for essential goods mixed with increased price sensitivity for discretionary items, particularly among lower income shoppers. So lower spending from consumers in general, Deirdre, what is the ability of firms at this point to pass along higher prices to consumers that might come from tariffs?
It's really difficult. I mean, I think the US consumer demand has been volatile for at least a year, and the situation with tariffs and the political situation is only going to aggravate that further. I mean, we had European companies like Unilever and Nestle last year talking about the bifurcation of the US consumer, with a lot more pressure being felt at the lower end. And I think a tariff war is only going to make that potentially worse. And we've seen today, you mentioned it earlier at the start, but Walmart is asking some of their Chinese suppliers to take a big hit. So there's going to be really difficult conversations going on between retailers and their suppliers. And they're probably going to both have to share some pain. Whether the supplier takes it all, I think, will leave some hard negotiations. But I think what we're also going to see is price inflation, because I just don't see how retailers will be able to absorb all the costs of a tariff war. And of course, they're not, you've got tariffs potentially in Canada and Mexico and China. So, we're seeing a reshaping of global trade here, and that's going to be very difficult to navigate.
It's just the level of discomfort that we've probably got to suffer. Deirdre, thank you very much, Deirdre Hippold. Looking ahead to Macy's and the angst of the consumer here in the United States of America. Coming up, it is ECB Day. We'll run through the slate for you on your agenda right here on Bloomberg Brief.
You're watching Bloomberg Brief. I'm Danny Berga alongside Manus Cranny in New York. Let's get you set up for your trading day on this Thursday. Earnings before the bell, Macy's, and then we're going to get Broadcom after the market close. Plus, the ECB will announce its rate decision. That comes at 8:15 a.m. Eastern, followed by President Lagarde's press conference at 8:30 a.m. And Treasury Secretary Scott Bessent will be speaking at the Economic Club of New York at 12 p.m.
More headline whiplash. Danny, keep an eye on the autos again. President Trump delaying the Canada and Mexico tariffs for a month on the automakers. What are they going to announce in the space of a month that will save them? Stellantis down 2%. It rallied by 9% yesterday. Marvel extending that post-earnings plunge as the results failed to meet pretty lofty expectations. Now, we've just flicked over to the bottom. Here we go. We're back to Marvel. And let's just flick it on to Broadcom, down just under 4%. Not looking great, I should say, ahead of their earnings. They come out after the market closes. Now we can talk about bonds, Danny.
There we go. You just set it up for us perfectly. Let's look at those bond markets that Manus gave you a little tease of. The sell-off continues. We're pushing higher by 6 basis points in Japan. We're higher by 9 basis points after the biggest one-day move for German bond markets since the 1990s. It is this feeling of, in the U.S., you have tariff and layoff headlines, that economic pessimism at a time where Europe has flipped on the stimulus switch.
Yeah, and I think, look, you made this point at 5 a.m. at the very start of the show. It's the differential between U.S. Treasuries and 10-year yields, and that is the spread that's going to be traded perhaps the most. We are capped, relatively capped in terms of the trajectory for us. We dropped by 10 basis points yesterday on growth scare, on the back of ADP, ahead of the jobs numbers. We are capped relatively to the drag higher in those global bond yields on fiscal issues globally, not in the U.S.
And I think it's important to acknowledge how different of a narrative that is from a mere few months ago when Bloomberg was at Davos. The conversation was pessimism among European executives, and everyone was so excited about the animal spirits being unleashed in the U.S. It's almost as if that narrative has done a complete 180 at this point.
Yeah, and the question is then, to what extent does the consumer? We've already seen it in terms of the optimism, the spending. Those have rolled over. We're in wartime economics. That's what Ludovic Subran said to us from Allianz. And that's got interesting ramifications across all markets.
All right, that is it for Brief. Surveillance.
They're up next. There you go. 2 for 1.